Right now, BigBear.ai, ticker BBAI, is trading at $5.36. That is a sharp drop intraday, down about 30 cents or 5.3%. The stock opened at $5.44 and has been sliding most of the morning, hitting a low of $5.29 on very heavy volume, already crossing 23 million shares traded. This is the central tension of this company, and it's what confuses so many investors. The expectation, fueled by a one-year chart showing a gain of over 285% and a recent high-profile U.S. Air Force contract win, is that this stock is an unstoppable force in the defense AI sector. The reality, however, is what we are seeing today, a significant pullback based on fear. The stock has actually fallen nearly 30% in the last month alone, and the reason is that the market is finally being forced to look past the headlines and at the numbers. The narrative is that BBAI is the next Palantir, a small, agile company locking in massive government contracts for biometric security and predictive intelligence. The reality is that the company is staring down an earnings report on Monday, November 10th, and the consensus estimates are not just bad, they are contradictory to the growth narrative. Analysts are forecasting a 25% year-over-year decrease in revenue. That is the disconnect driving today's sell-off. The expectation is explosive growth. The data suggests contraction. Let's first look at the common ground, the story everyone believes. BigBear.ai is perfectly positioned. It provides artificial intelligence solutions for national defense, intelligence, and homeland security. When you hear about their Veriscan biometric identity platform being rolled out at airports or their new contracts with the Air Force, it's easy to get excited. The company is frequently mentioned in the same breath as Palantir on forums across Reddit and X.com, with retail investors pointing to a potential $900 million government contract and the recent acquisition of Pangiam, a facial recognition specialist, as proof that this is a ground floor opportunity. This narrative is powerful, and it's what took the stock from under $2 to over $10 in the past year. It's a story of a small company with a $2.4 billion market cap successfully competing for and winning contracts against giants. Now let's challenge that. The market is beginning to question if BBAI is a victim of its own hype, and the evidence is compelling. The entire bull case rests on future growth, but the company's recent performance has been weak. In the second quarter, revenues missed estimates and fell 18% year-over-year, which the company blamed on lower volumes from Army programs. The concern, and the reason the stock is weak today, is that the upcoming third quarter report on Monday will show the same thing. The consensus is for a loss of 6 cents per share, which is wider than the 5-cent loss from a year ago. And revenue is expected to be around $31.1 million, a steep 25% drop. This is where the story breaks down. You cannot be the next great AI growth stock while simultaneously reporting a 25% decline in revenue. This high beta stock, which moves with extreme volatility, is now pricing in the risk that Monday's report will confirm the company is struggling to convert its big contract announcements into actual billable revenue. This brings us to the most critical and perhaps most misunderstood aspect of BBAI, the short interest. This stock is one of the most heavily bet against names in the AI sector. According to the most recent data from Fintel, the short interest is massive, clocking in at 76.75 million shares. That represents 17.71% of the entire free float. This is not a small, quiet bet. This is a significant, directional attack on the stock's valuation. The short thesis is simple. BBAI is unprofitable, with a negative PE ratio and shrinking revenues, yet it's trading at a price-to-sales ratio of over 20, a valuation that assumes flawless, rapid growth, not a 25% contraction. The shorts are betting that the AI hype will fade, and when it does, the stock will reprice based on its actual and currently disappointing fundamentals. Now, for those watching this, it is critical to understand what this short interest does and does not mean. This is an actionable insight for every investor. You can find this data on sites like Fintel or directly from the exchange. When you see a 17.71% short float, your first thought might be short squeeze. But you must look deeper. The borrow rate, or the fee to borrow shares to short, is only 0.59%. That is extremely low. It means shares are plentiful and easy to borrow. Furthermore, the days to cover ratio is only 1.11 days. This metric, which divides the total short interest by the average daily trading volume, tells you how long it would take all the shorts to buy back their shares. A ratio of 1.11 days is very, very low. It means that because BigBear.ai trades with such high volume, the shorts are not trapped. They can get in and out with ease. This combination of a low borrow rate and low days to cover suggests this is not a setup for a squeeze, where shorts are forced to buy. Instead, it suggests that bearish investors are comfortably holding their positions, confident that the upcoming earnings report will prove their thesis correct. What's your take on the 17.7% short float? Is this smart money seeing the revenue decline, or just fuel for the next rally? This battle is playing out everywhere online. Retail investors are dissecting dark pool short volume, which has been high, and trying to find a floor. One of the most interesting topics of discussion is the company's convertible debt. BigBear.ai has notes that can be converted to common stock at a price of $3.55 per share. Even more importantly, there is a provision that allows the company to force conversion if the stock closes above 130% of that price, which is roughly $4.62 for a specific period. This creates a complex dynamic. Some investors on social media believe there are forces actively trying to keep the stock price suppressed below that $4.62 level to prevent that conversion. Whether that's true or not, it adds another layer of technical pressure on the stock, completely separate from the fundamental story. So, who is this company really? Setting aside the chart, BigBear.ai is a legitimate defense contractor. Its business is built on providing advanced analytics and AI-driven decision-making tools to clients that can't afford to be wrong. This includes the Department of Defense, the U.S. intelligence community, and the Department of Homeland Security. Their Conductor OS platform is designed to help orchestrate autonomous systems, like swarms of drones for the military. Their Arcus platform provides maritime domain awareness, helping the Navy track threats. And their Veriscan biometric system is what's being deployed at airports to speed up passenger processing for customs and border protection. This is a real business with real technology, which is why institutions like Vanguard and BlackRock hold significant positions. The problem isn't the technology, it's the valuation and the execution. This is why the upcoming earnings call is everything. The expectation is that the new Air Force contract and the expansion of their biometric solutions will be the headline. The reality the market is bracing for is that the loss of revenue from older Army programs will create a hole too big to fill this quarter. Analysts are mixed. H.C. Wainwright has a buy rating but dropped its price target to $8. Others, like Trefis, have published analyses suggesting the stock could fall back to the $4 level if the growth story is proven false. The institutional hold consensus reflects this profound uncertainty. We are at a true inflection point. This isn't about hype anymore. It's about proof. Comment below with your average cost basis on BigBear.ai. It's always insightful to see where the community is positioned heading into a major catalyst event like this. Looking forward, the picture is incredibly cloudy, and it all comes down to Monday. If BigBear.ai management comes out and reports a surprise beat or provides guidance that shows the revenue contraction is over and the new contracts are ramping faster than expected, this high short interest will be rocket fuel.
The 17.7% float shorted will have to cover, and with a beta of 3.42, this stock could reclaim its recent highs very quickly. That is the bull case. The bear case, which the market is pricing in today, is that the company confirms the revenue decline, offers weak guidance, and proves that the $390 million in cash on its balance sheet is simply being used to weather a severe operational downturn. If that happens, the shorts will be validated, and the $4 price target discussed by Trefis becomes a very real possibility. In the end, the story of BigBear.ai is a perfect example of market tension. The expectation is a disruptive AI defense company on the verge of massive growth. The reality for now is a company with shrinking revenue, no profits, and a massive target on its back from short sellers. Today's 5% drop is the market's way of saying the hype is no longer enough. The company must now deliver the numbers.